Hey, this is Mike Diercksen from Proactive, and you're listening to the Building Bite podcast. Tune in as we spotlight our guest, Daniel Fulcher, Account Executive Director of Construction Services at Travelers. Our episode is focused on project loss insurance, what it covers, and how to best utilize it. For more information on this episode and others, please check out the Building Bite at www.buildwithproactive.com.
Welcome to the Building Bite Podcast, a podcast for construction contractors, owners, and insurance professionals, where you'll hear from the experts about key topics to help you be successful. I'm Chris Epps, a Vice President with Proactive, and I'm joined here with my co-host, Mike Diercksen, our Manager of Marketing and Business Development. Our guest today is a leader in the surety and insurance space, Daniel Fulcher. Daniel is the Account Executive Director of Construction Services at Travelers. Daniel, how are you this afternoon?
I'm doing well. Thanks for having me.
Absolutely. We're glad to have you. Mike, how about yourself?
Doing great, Chris. Really excited to talk to Daniel and kind of dive into project loss insurance. It's a really interesting topic.
Absolutely. Let's get to it. Daniel, thank you again for joining our show today. Definitely a real pleasure to connect with you. Before we dive into our main topic, I was hoping maybe you could tell our audience a little bit about yourself and your background, your career, and kind of how you got to Travelers.
Sure. Well, I'm a local guy here to Raleigh. I still live in the Raleigh area. Went to North Carolina State University, who we had a big win against Clemson this past weekend, which is nice. Worked at a local law firm for a while right out of school, and then started at Travelers a little over 16 years ago in the RTP office in the contract surety space, and I continue to do that. So surety bonds for contractors is my background, primarily for contractors in the Carolinas, but sometimes beyond those confines. And then in addition to that role, about 4.5 years ago, I was pulled into the project loss insurance team before we went live to put kind of the finishing touches on the policy and discuss the marketing strategy and things like that. And then we ultimately went live with the product in November of 2020 after a slight COVID delay. And initially, I was kind of a regional role from, say, Pennsylvania down through the Southeast into Florida, and then have just recently stepped into a co-national role with a counterpart of mine with the product. So really, really excited to talk to you more about it and let people know what it is.
Yeah, Daniel, this is going to be great. And I know a lot of the people work at our firm as well, NC State grads. So I've heard a lot about that football game this week. So anyway, diving right into our topic, though, which is project loss insurance, what it covers and how to best utilize it. We talked about this earlier off camera, and you just got a wealth of information here, being one of the founding members, helping to craft the policy and what you're looking to do with it. So for those, again, it's project loss insurance, or PLI for short. Can you give us the 10,000-foot overview, Daniel, of like what it is and how it's helping your clients?
Sure. Well, I'll start with this is, construction is just a risky business, right? And prior to our coverage, there were these risks in the space that you couldn't really insure, or maybe you could insure bits and pieces of it, kind of cobbling together some other coverages. But we're really a broad coverage on catastrophic project loss. So not just like a project fade or something like that, but these jobs that really get in the ditch and have a large negative financial impact to the organization as a whole. And so that's what we're insuring against, is trying to kind of feed liquidity in those scenarios and help the gears keep turning. And the way we like to think about it is divided in kind of 3 buckets of risk to the contractor on any given project. We think about it of their own mistakes, so to speak. This could be a bid error, putting the wrong manager on a job, just some missed assumptions, things of that nature. Then we also have, the third-party impact risk. These are going to be a subcontractor impact, either from poor performance, or maybe they walk on you before they're ever under contract and you have to pay a large delta to get them replaced with the second number. And supply chain issues, material price increases, which of course been huge as of late. And then the third bucket is a little bit of a miscellaneous, this is where we pick up your liquidated damages, actual damages. Anytime you have like a weather delay where maybe you even get time, but you don't have additional general conditions and other costs reimbursed. And so again, what we cover is a project loss, but a project loss covered by those types of issues. And so traditionally, the only way you could cover that type of exposure was, with additional markup, additional contingency, just trying to make assumptions as to how late you would be or how long something would take, and really crossed fingers at the end of the day, right? And now our product kind of gives you a downside hedge for those types of risks. But I'd really say what we do at its core is that we reinsure the balance sheet of the construction company to keep them financially viable. And that's big, we think, because a lot of the companies we work with, and I know that you work with, they're privately held businesses where you got 1, 2, maybe 5, 10 owners that are really invested on a personal level in the company. And so you're protecting that balance sheet and that investment from a downside risk. So the last thing I'll say on that is that I like to think of it that, every time a contractor executes a contract, enters into a new job, they're in a way betting or investing their balance sheet in that job for whatever return that job's going to bring. And again, our product gives them a downside hedge for that job going haywire. And we accomplish that by stretching the coverage across all new work as new contracts are signed. And we apply the premium and coverage as those new contracts are signed. And that's how it works. We will let people institute a floor if they want, so they can kind of only cover jobs over a certain size and localize the coverage to their larger work. But that's something that we could get more granular into with someone if they're interested.
Daniel, you mentioned that Travelers is the only carrier currently offering this kind of holistic DLI coverage. What was the impetus to develop and create this line of coverage? Is there a specific size or type of contractor that was driving that, or maybe that benefits most from this coverage, or what was the driver there?
Sure. Well, I'll say that, yeah, to my knowledge, we're the only one in the market. And to give a slight history on it, we have a lot of data. Thankfully, at Travelers, we're a very large surety provider. I looked this morning, we have about 4,400 active accounts across North America currently. And we have about 18 years of really solid financial data of work in progress schedules on those clients, and then also people we've considered bonds for, or that we wrote bonds for, and those companies are no longer around. And so taking a deep dive into that data, our actuaries found that a 15 to 20% loss on a project is not an uncommon event, and occasionally can be worse. In the really odd scenario, we'll even see 100% loss on a project. So that kind of taught us that the risk is there. The other thing is, we take a deep dive into our top 10 surety losses every year. We've done that for 13 years now. And we just try to see, is there anything we can learn from that study that we could impart upon our clients and our underwriters? And we saw a trend line there as well. So about 60% of the time, those companies who are companies that are typically, out of business and they've handed us the keys, about 60% of the time that's driven by one catastrophic project. And that's even been on the uptick over the last few years. So our thought was, hey, it's good. It's good for that business owner and frankly, good for us if we can keep those good companies in business, right? And then the final piece was, frankly, we had a couple of clients that, we said, hey, you're a great partner, and what can we do for you? As this was as a surety talking to them, and they mentioned this risk and the fact that, as an insurer, we could have the scale to help them address these types of risks. So that's kind of the history of what got us into the space. To your question on who are we most focused on, we kind of thought about maybe 10 million to 500 million revenue companies would be our focus. And I'd tell you, that's still our sweet spot. We've been pleasantly surprised that even some kind of E&R top 25, top 50 type scale clients have approached us for some kind of bespoke manuscript solutions that we've worked on. But I would say that out of the gate right now, our kind of max cover on one job is $10 million. Okay. So that's not a $10 million job or even a $10 million loss. That's just total dollars out the door from us. So I would just say, if you're the type of company that a $10 million hit to your balance sheet would be material, then you're the type of company that I think could benefit from the coverage. And, if you're of a scale that that would not be material, then, we may be able to come up with a different solution. But certainly that middle market space, I think there's a lot of people that could really benefit from the coverage.
Yeah, it's a pretty material figure to most companies, I think, at that level, right?
Yeah.
And two, I would have to imagine, coming out of COVID and all the problems stemming from that, man, that's got to be very, very attractive to a large portion of that ENR top 500 firms that just, material shortages and supply chain disruptions and all the indirect costs that come along with those associated project delays. And, the fact that you kind of have this wholesale coverage for those type losses where you can have combined and overlapping problems. I'd got to imagine that sounds really, really attractive to a lot of our GC community. Given that, you had mentioned a couple of you guys doing deep dives on some lessons learned and things like that. Can you walk us through maybe a case study? We find our audience tends to relate to stories and examples and stick with some of those case studies. Is there an example you could give us where you guys have kind of implemented this successfully and where it's really benefited some of your clients?
Sure. Well, I'd say that the kind of the use case that has been, most common. I mean, there's kind of a number of different times people have approached us, but two that specifically come to mind is, a lot of times with ownership transition, a lot of times those are self-financed by the business or by the business owner and are long-term, 5, 7, 10-year transactions. And so one specific case comes to mind, but there's been a multitude of these where, there was a gentleman that he's transitioning the business. He's going to step away from running the day-to-day a little bit, has a very capable person running the day-to-day, but it's still, it feels a little different when you're on vacation in Europe with your wife than when you're sitting at your desk. And there was a peace of mind there, knowing that, okay, I'm still heavily invested in this business and I have kind of a backstop if something did go sideways. Another use case is, we've had a lot of people with a lot of success of just approaching their owners that they work with and say, hey, look, I have risk and I got to cover that risk and price that risk somehow through markup, through contingency somehow, and that they've been successful passing this through on projects. And, when you're able to do that, it kind of becomes a no-brainer, because if it's a pass-through cost, you're getting a downside hedge on the house, so to speak. So those have been two times we've implemented it. I will say, we actually haven't had a loss to date, but I'll explain how that would pay out. Is that they would keep the first layer of a loss, wherever that retention level is, and then we would reimburse the loss throughout the job until it's done, usually on a 75-25 split. So the way I like to boil it down is we're simply just reimbursing 75 cents of every dollar lost above your retention until we've exhausted our policy limit. So that's the whole game plan is get liquidity in the hands of the contractor, because usually you solve a problem in construction by throwing money at it, frankly, as you well know.
Yeah, no, and it's so important, right, to mitigate that loss if you get to that position, and keeping that cash flow going certainly does help that, and it prevents it from snowballing to larger and bigger issues.
Right.
But Daniel, something that caught my eye about this and talking about PLI insurance, and it seems to have a lot of similarities, right? We focus a lot on subcontractor default insurance, surety, but PLI seems to be unique in its own right. Is this a coverage that you see insureds, successfully implementing on top of those coverages in tandem with them, or is it kind of on its own?
Yeah, sure. Well, the short answer is yes, but the elongated answer is that, yeah, I don't see us competing with bonds and SDI products. I see us, coming hand in hand with those. We have clients that are utilizing bonds and PLI, and clients that are utilizing SDI and PLI. The bond and the SDI products are of course focused specifically on the subcontractor risk, which is a real risk, one of the larger risks to any firm, right? That's subbing out work. But PLI is broader. It's coming in, for that cat job. And so we would even pick up, if you have a loss that's being driven by a problem sub, any amount that a bond doesn't cover or something like your retention amount on SDI, all that would be cost that flows into our covered project loss. But what we find is normally if you have a couple of problem subs, maybe you have a difficult owner, maybe there's other issues going on all at once in these catastrophic projects. So, we think that there's space in the sandbox for all three of those products to be able to give a holistic coverage to a general contractor, which is another thing I should comment, saying general contractor, we also cover highway heavy and subs. So, whereas those clients can purchase sub bonds, usually SDI is not going to be available in those spaces. So that's another way we can come in and, again, provide that broad coverage, liquidated damages, actual damages, missed bids, all those types of things. And so, I think that you can definitely utilize all of those products at the same time.
Yeah, it's very interesting. I hadn't thought about that coverage across. You talked about heavy highway and civil and subs and particularly bonded projects, maybe federal projects, and that's pretty expansive coverage with a dynamic solution to help risk managers, from a lot of different organizations, really mitigate different layers of risk for the entire company and provide some unique solutions to what can really be complex problems and maybe a myriad of problems, compound problems oftentimes, right? Where do you kind of see the future of the product going as you guys have kind of developed and built on this, and maybe feedback you're getting from the market, hey, can you guys do X for us? Where do you see the PLI product headed maybe in the next 5-10 years?
Yeah, that's a fun thing to think about. All right. First to look in the rear view mirror, I mean, we've only been in this business for a short while, and already we've introduced a lot more flexibility and kind of customization to the product that I think has really gained some traction in the marketplace. So that's nice. More and more we're getting calls, I think, as people learn about it and learn that it's out there. And so, I would say over the next 5-10 years, clearly, we're hoping for just ubiquitous use across the industry, right, of the product. And a couple of things. We think that it could improve your terms as you're talking to banks. I mean, I'm not going to do their job for them, but clearly if they know that you have a product that's going to help in a bad job scenario, you would think it would help terms there. Certainly can strengthen the way a surety looks at you. I know that's how we feel, here as a surety, because you have that backstop that would step in, in a bad situation. And I think over the next 5 to 10 years, I'd like it to see it become, the go-to tool in the tool belt in some of these things we've already talked about, whether it be an ownership transition to smooth and limit the risk there in that financial transaction. Certainly, we get a lot of calls on ESOPs because of the fiduciary responsibility there. I think we'll see more and more ESOP companies utilizing the product over the next 5 to 10 years. But, really, I think it'll be the go-to tool at those inflection points in the business, because those are the points where risk rises as well, right? So I really think anytime you get to a scale where the owners of the business are having to delegate authority to people that are non-owners, not that risk isn't there when it's just owners doing it, right? But when you have people that don't have the same skin in the game, kind of risk in your balance sheet, I think that's a time that it's even more imperative to have a backstop in place. So I think we'll see larger contractors utilizing it more in the captive space as well. We've had a lot of calls about that, and I'm not a captive expert. There's plenty of people out there that can help you with that, but utilizing our product in that space, I think we're going to see more and more. But I think the thing that excites me most about the product is that, after being in this business for 16 years, you see plenty of good people that their business gets dinged up by a bad job. And so I look forward to seeing businesses getting saved by this and saving those jobs, saving that personal investment for the business owner. And that's the thing that I'm looking forward to the most in an odd way over the next 5 to 10 years is some of our loss activity and stepping up and really partnering with people in their time of need.
Yeah, I could even see that. You talked about those different inflection points for like moving to maybe an ESOP program or a sale of the company or transition, succession planning, that sort of thing. But
Yeah.
even taking a step back and looking at, as companies grow, those inflection points of growth, and protecting the company at some of those times when you have subcontractors trying to grow and contractors trying to grow from maybe a local contractor to more of a regional reach or even broader, increasing that scale. Seems like this would still be a wonderful tool for helping protect that, even short of not having necessarily an inflection point for transition of the company, but even just for company growth, it seems like a great protective tool.
Yeah. Agree.
Yeah, no, Daniel, this has been an awesome conversation, and we really appreciate your time and your willingness to talk to us about the product. One thing we like to do on the show is we always like to ask our guests if there's 3 takeaways. Again, reminding you that our listeners are, generally speaking, stakeholders in the construction insurance process. So there's carriers, brokers, GCs, risk managers. What would you say the big 3 takeaways should be after listening to today's episode?
Well, the first that comes to mind, and the risk managers listen to this will just be amening me, but so I guess I'm more talking to the business owners, but don't allow yourself to become numb to risk. I mean, I think that can happen to underwriters, that can happen to contractors for sure. We can get lulled into kind of good times and things rolling, and really on any specific bid, you're really having to make some assumptions on some big things, right? Unfortunately, you got to price your product before you build it, and so sometimes you are making kind of the most rosy assumption on a number of things until it stacks into a problem. And so that's one takeaway, is to not be numb to risk. The second is just simply remember, project loss insurance is there to hedge against those risks. So remember that. And then the third would be, don't mishear us here. This is not a get out of jail free card. We're not here to give a mulligan to poorly run operations. We want to partner with really solid businesses, just like we do in the surety space, that are well run, good management teams, good track records. But we're trying to give them a backstop, because we see that even really high quality organizations can get a tiger by the tail. And so that's what we want to do, and look forward to doing that.
And what about an action item, Daniel? If our listeners are looking to make a change, or you got a risk manager out there who's listening right now, potentially looking at this solution, what would you say is the best starting place? What's action item number 1?
Sure. Well, so this is a surplus product, so you're going to need to reach out to an agent, and I'd say maybe start with your surety agent for getting a PLI quote. I say that because while it's an insurance product, this did come out of the surety space, and the underwriting is very much credit-based financial underwrite, similar to surety bonds. But again, as long as you have a surplus lines agent, they can reach out to me, and we can talk more about coverages and structuring a specific solution for you and your business.
Fantastic. And before we let you go, we always like to hit our guests with a couple of rapid fire questions. So I'll start. Where do you see people struggling the most with PLI insurance? Is it the concept, because it is relatively new to market, or is it really on the implementation side, or a mix of both? Where do you see people struggling most with PLI?
That's a good question. I think that the concept they grasp. I mean, I think they understand. When we talk about, well, what if you make a bid error? What if you have a sub walk on you? What if you get into liquidated damages? I mean, they see those risks. They've either had a bad project, or they know a friend up the street that's had a bad project. They can kind of get their arms around that. I think the hurdles are twofold, really. One, people don't think it's going to happen to them necessarily, as long as they select the right jobs and they have, solid oversight. And look, I agree that those things de-risk, your business. And I applaud people for doing that. I think you should do it. But construction just is tough, and curveballs get thrown. And so I think that's one thing, is getting over that hurdle that a bad job can happen. And then second, I'll be honest with it, that it is, of course, an additional cost. We live in a time with a lot of inflation and a lot of increased cost and all that. So you're having to stomach a new cost. But But my response to that would be that, first, our clients have been very successful in being able to job cost these costs, whether it be in an insurance composite rate or, a direct conversation with an owner or however they find to do it. And then again, that you need to cover your risk somehow. And this is a way that for a fraction of a percent of the contract price, you're getting, kind of an outsized, downsized, hedge. So, you're getting, depending on your policy, $4, $5, $10 million of coverage for that fraction of a percent. So I think it's a good kind of trade reward there to cover that downside risk.
It makes sense to me. I feel like I'm a pretty good driver, but I still buy auto insurance, right? And
That's right. That's right.
Kind of got to worry about everybody else and market conditions, and it's all those other factors too. Even if you are one of those well-run GCs, so
that's right.
That's a great takeaway.
Yeah, Daniel. What about slightly different kind of question, but just a professional tip, right? You've seen a lot of things through your experience here. What would be a good professional tip for our listeners here?
Yeah, that's an interesting one, and not to get too preachy, I guess. But to me, I think it's just being a lifelong learner, and the way I like to approach things is that, and maybe it's easy. I'm not that sharp, but that anybody I meet, there's something that I can learn from them, and the more seasoned we get in business, I think there's a draw to want to just, nod your head and say, oh yeah, I understand. And, just saying, hey, explain that to me a little further. It can really broaden your horizons. You learn a lot of great things that way. And I have the pleasure of working with a bunch of really smart people, both here at Travelers and my clients in the surety and PLI space. So I get to learn a lot every day. And that, that makes it exciting to wake up every morning. So.
Yeah, that's great. I think regardless of where you are in your career, that's a great piece of advice. Lastly, Daniel, before we let you go, so this is the Building Bite. That's building insurance technologies with the experts. You're today's expert. We always like to ask, what are you taking a bite out of today? We got a home base in Raleigh, North Carolina, so I'm a little familiar with the food scene there, but where's the number one spot for you to go for?
Well, I'll say this. I've lived most of my life in Raleigh, but I'm an Eastern North Carolina boy originally. So any hole in the wall, Eastern North Carolina barbecue place you want to take me, I'll go with you. And then, but if I'm trying to be a little healthier, it seems like one of the go-to places for a business lunch in this area is J. Alexander's over by Crabtree. They have a nice little ahi tuna salad that, is light and won't have you, wanting to take a nap at 2:30 in the afternoon. So those two ends of the spectrum have it covered there for me.
Nice.
I feel like you're going to connect with a lot of our audience between those two options. I'll lean towards that barbecue sandwich, but
there you go.
Daniel, thank you for taking the time to chat with us today. If our listeners want to hook up with you after the podcast, where can they find you? LinkedIn, email, TikTok account? I don't know. Where can they get a hold of you?
Well, I don't have a TikTok, so sorry about that. But yeah, you can reach out on LinkedIn. You can email me at dfulcher@travelers.com if you just want to discuss, things in general. And then again, if you're looking for a quote, please reach out to your surplus agent. And I really appreciate you all's time today, and for everybody listening out there, your time as well.
Absolutely. We appreciate it. Thank you again for taking the time out today, and look forward to catching up with you in person soon.
Thank you for listening to The Building Bite. This podcast has been brought to you by Proactive. Check us out on thebuildingbite.com, where you can subscribe to our newsletter and follow us on social media for all future The Building Bite news and updates. You can also find us on your favorite apps, including Apple and Google Podcasts, Spotify, Stitcher, TuneIn, and Amazon. If you have ideas for episode topics that we should cover on the show, or you know somebody who would be a perfect guest, let us know at connect@thebuildingbite.com.